Don't buy the dip. This market is going to go much lower and there is a lot more pain ahead for retail investors. That's all the stuff we're starting to hear from retail investors on Twitter, YouTube, and all these social media platforms all of a sudden here in 2022, even though the market is already down around 35%. And so in this video, I want to share with you guys why I am personally so disappointed in the way that retail investors are handling this market crash. We've seen the sentiment shift drastically from where we were a year ago to basically everybody telling you that you should not buy the dip, you should forget about the stock market, and that we're going to go into a depression for the next couple of years as inflation stays high and as we see no economic growth. But in this video, I'm going to show you guys some critical data that is going to set the bar straight when it comes to understanding how the market reacts during high inflation times. And I'm here to tell you that it is not what you think, and most of the people on social media telling you not to buy the dip are complete idiots. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing I want to start off by is addressing somebody called Paul Volcker. I'm sure you guys have heard of this person over the past couple of months as we've heard talks of higher interest rates and bringing down inflation. This person was the chairperson of the Fed back in the 1970s, which is when we saw the US dollar go off the gold standard. And what did Paul Volcker have to do, which was very significant? Well, he had to fight record high double-digit inflation. He's the person who ended stagflation in the 1970s by raising interest rates to almost 20% in the December of 1980, which put us into a recession in 1981, which lasted until 1983. And it seems like this is precisely what is scaring a lot of investors right now from investing in the stock market, because people think we could be going into another Volcker type of moment. Well, in this video, I want to set the myths straight. It seems like people are essentially telling us that despite the current pullback we have seen in the stock market, the market is going to go even lower if the Fed induces a recession with its very tight monetary policy. Well, let's debunk that right now. If we actually go back to the S&P 500 of the 1980s, as you can see, between 1970 and 1980, the market actually returned around 30% during that time, from the start of the decade to the end of the decade. And from the highs to the lows, that's around a 66% gain. And the recession that we experienced in 1981, which is essentially represented by this little pullback right here, only falls to be around that 25% decline. And as you can clearly see, in the years preceding after that massive interest rate hike and the collapse of the two-digit inflation numbers and CPI reads that we were seeing during this time, the stock market still ended up rallying for the years preceding, even though most people probably thought we're going to go into a depressionary period and that the stock market would essentially never recover. And as you can see, the Fed funds rate back then was raised all the way to 19%. To put that into perspective, right now, we're sitting at only around 1.5%, even after the massive 75% rate hike we saw earlier this month. And so if people are so fearful about us going into this recession and causing the stock market to get absolutely destroyed, why did the stock market still give us very good returns even following this 1982 recession that many people are talking about? Well, the difference is, as you can clearly see, the pain in the stock market was already priced in well ahead of time. All this volatility that we saw in the 1970s was pricing in this massive interest rate hike that we were expected to see by Paul Volcker. And that right there is exactly the situation that we're going through right now. I know everybody's telling you, don't buy the dip. This market's going to go lower. But these people are telling you to not buy the dip after the market has collapsed what is it, around 25% from its all-time highs right now on the S&P 500 at least, and a further 35% on the NASDAQ. Where were these people in 2021 and in 2020, which is when the market was actually considered overvalued by many indicators? These people are now coming out to tell you to not buy the dip when you're actually supposed to be buying the dip historically. It's like saying not to buy the dip during times like this and during times like this, which is when we're seeing peak fear in the market and the situation looks grim, but those that understand basic psychology of the market understand that the stock market always looks ahead 6 to 12 months. So it doesn't matter what's going on currently, the market is always going to look at what's going to happen in the future. Because if everybody was going to buy and sell based on what's going to happen today, then everybody would be millionaires and billionaires from the stock market, and it would be extremely easy to make money from stocks. But instead, we know 90% of retail investors still lose money in this game. And it's the simple seasons that result in that. Meaning it's a simple seasonality in the stock market that we're seeing and we're going through right now that's going to cause that kind of massive destruction in retail investor wealth. And as we've clearly seen, the stock market didn't end up going into depression, and we actually had a very nice rally in the 80s. And so you do not need to listen to all these people telling you don't buy the dip, because they are complete clowns. They have no idea what they're talking about. And back in the 1980s, we had a much more severe recession that was induced by an economic problem, which is when we got off the gold standard. And that caused the dollar to be significantly devalued, which pushed up inflation. And if this is the biggest correction during that recessionary period that we saw, then during a time like this, when unemployment is still at record lows, this correction right here is probably already pricing in a lot of the pain that we're expected to see of this recession caused by the Fed. The stock market is already pricing this in ahead of time because we haven't even gone into the recession. And that is precisely why going into the end of this year and potentially in 2023, the market could already be bottoming, and we could see these very cheap prices not sustain because the market's going to look ahead of time. And as retail investors capitulate, as we've already seen, markets are going to potentially rebound to all-time highs, which is obviously by that time when most retail investors are actually going to flip bullish, which is obviously going to be way too late. And it's tweets like this that really get my gears churning. I don't like to spread fear on Twitter and social media because I think it is absolutely not our job as retail investors to convince other retail investors to do what has historically been proven to be wrong, which is trying to time the market and expecting the market to go down even more before buying the dip. Yes, we've seen a 43% decline in wealth, but that is the best buying opportunity that you're ever going to see. If our job is to buy as investors, do we buy when stocks are cheap and when we're seeing a lot of fear, or do we buy when stocks are at all-time highs? Right now, we are seeing the latter, and that is exactly why it's time to buy the dip instead of being fearful, because you never know when these cheap asset prices are going to last. Instead, you're seeing people like these on Twitter that are all of a sudden market experts telling us that the market is overvalued and that the bear market is going to last much more than it has right now. Well, guess what? These are probably the same people that were telling you in 2021 to buy GameStop and AMC because the market was going to go to the moon. And if you said anything otherwise, you would have probably gone roasted in the comment section. And these people are basically basing all their decisions around the stock market based on what the price action is doing. And it's taken a 6-month-long bear market for these people to now say that the market is going to experience a bear market for another year or so and that there's going to be no end in sight for all this pain. These are the same people that were probably telling you to buy the dip in 2020 and in 2021. And so the bottom line is, guys, don't listen to these clowns that are telling you not to buy the dip, because chances are they already panic sold their positions and took a massive realized loss, and they're holding a lot of cash, and they just want to get other people to be in the same boat as them, which they obviously know is a losing boat. Because guess what? If they're not going to buy the dip during times like this, when 58% of all investors are bearish for at least the next 6 months, then they're never going to buy the dip, because every single rally they see is going to feel like a fake rally, even the rally that takes us to the bottom. And so for me, the bottom line is, guys, you want to consistently invest in your favorite companies no matter what the market does. And even though right now we are seeing the worst returns in both the bond market and the stock market, We need to realize that this is an opportunity because it's very rare that we see all asset classes give us such a poor returns in such a short amount of time. We are basically seeing a capitulation in the broader equity and the bond market. It's just that most people don't realize it. And as we all know, most people have been waiting for that capitulation phase, but the data is already showing us we're already in that capitulation phase right now, and that the market could start rebounding sooner than you think. No, the market is not going to bottom in the short term. I don't know when the market's going to bottom, but my job is not to find when the market's going to bottom. My job is to buy the dip during times of uncertainty and to reap the rewards during times of certainty over the next couple of years. And so all we're seeing in this market right now, guys, is people chasing short-term gratification to seem right and sound right in the short term by predicting that the market's going to go even lower. But obviously that's the easy way out. The difficult thing is to be bullish throughout this entire period in the down phase, and that's where the 10% of investors actually end up succeeding. And the media's job is just to spread you the same information that you've been probably hearing for the past 6 months and to give you the current outlook on the market, not the future outlook on the market, which is what us investors should really focus on. But anyways, guys, that's just my take on what's been going on in the stock market. Let me know down in the comment section below your guys' thoughts on all of this don't buy the dip talk. I'd definitely be very interested in hearing your guys' opinions. But as usual, guys, make sure to drop me a thumbs up, and I'll catch you guys in the next one. Take care.